Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral, Dadia. We have with us Vandana, founder and CEO of Vanda Insights, joining in. Very warm welcome, Vanda, and thank you for finding time for us from Singapore as we were just talking. I'm glad to hear that things have improved over there. We're all praying that things improve here as well. But my first question coming to you over here is, with what's happening with crude, the kind of hit that we saw, in the month of March as well, and the rebound that has come in right now, what should someone really make out of it?
So first of all, thank you so much for having me on your show. It's absolute pleasure. I've watched some of your other clips and you do a really good job. When it comes to the crude markets, some of the worries that you and I were just discussing offline with regards to the coronavirus, how soon economies can go back to normal, how soon we can go back to our normal ways of life. Pretty much these are right now the worries in the global financial markets, and oil is one of them. Now, of course, when you talk about the oil markets, you look at the fundamentals of supply and demand. And then, of course, there's always other factors that affect it. But right now, let's just focus on supply and demand. As far as supply is concerned, after the initial hitch through March and April, when we saw the near disintegration of OPEC, non-OPEC alliance, that has come back on track. So they have really tightened supply, nearly 10 million barrels per day of oil taken off the market. But when it comes to demand, now the rest of the part in terms of rebalancing the market has to come from the demand front. And this is where it's neither predictable and nor can it be rushed. So as we all know, this is a completely unprecedented situation. It's very hard to see how countries will respond to the renewed outbreaks, clusters of infections, spikes in cases, hospitalizations that we are seeing. So it's happening in Beijing, it's happening in Germany, it's happening in some states of the US. So, that's where crude is basically sort of trapped right now. On the one hand, you have supply, which is looking quite tight relative to April and May. But if you look at demand, it's not come back, nowhere near come back close to normal levels. So that's why I've been saying that we've seen Brent climb up to the low 40s from a low of $19 not so long ago. But it now seems like it could be range bound here a little bit because demand needs to do the rest of the work.
Right. And with this, Vanda, today itself, I think overnight, we did see crude which settled above that $40 per barrel. And this was for the first time we saw these closing levels since March. Now, do you think there is still some room for crude to move higher? Because I remember a couple of months ago, probably almost a year ago, we were having a conversation when crude had already crossed 100, where the $100 was something which was sustainable. Now, even if crude goes back to say $50, $55 a barrel, do you think that's something which is going to be a sustainable level?
As far as 100 is concerned, I think for the foreseeable future, perhaps forever, if I stick my neck out, 60 might be the new 100. But that aside, what we have seen in the last few days is basically crude prices responding to plenty of signs around the world that supply is rebalancing. So we came out from an absolute crater of up to 20 to 25 million barrels per day, equivalent percentage of global demand that had just disappeared in April. And now we are, and as economies began to reopen through May, the signs were, it started to emerge, the green shoots of demand. As we sit here in June now, the estimates are that probably oil markets are actually balanced. If you look at the US Energy Information Administration's latest estimates, it's actually predicting a little bit of an undersupply in June. So basically demand being a little above supply. Right now for the market though, as I said earlier, one is of course, when does demand come back to normal? And the other thing also is that OPEC and non-OPEC are not going to maintain these cuts. It's just impossible for them to do it as well. And they just won't. And we can talk about that for various ideological reasons. They don't want to give the US shale a shot in the arm again at their expense. So we expect the cuts to start tapering, to start declining starting in August. So, the market is like trying to balance. So what happens from August to December when the cuts will not be as big? Will demand have come back? And it's also looking at what's happening now, which is that the market looks quite balanced. But there's, as always, a lot of factors that need to be taken into consideration when it comes to assessing the oil market.
Right. So, Vanda, when we're saying that, the cuts will start tapering off from the month of August, with this, by how much do you expect that number will come down to?
So if we talk in exact terms, the agreement back in April was for 9.7 million barrels per day of cuts between OPEC and non-OPEC. And it was earlier this month, they agreed to, so that was initially applicable only for May and June. Earlier this month, they said, perhaps we need to tighten it a little bit longer. So let's keep it at this level of cuts for July. So that was the agreement that we saw earlier this month. And most importantly, Russia and Saudi Arabia had to see eye to eye on that, and they did. Now, as per the original plan, the cuts would have tapered to about 7.7 from 9.7. So 2 million barrels per day of oil basically to be put back into the market starting in July was the original plan. Now the understanding is, of course, they're going to meet again at the end of this month and decide what they want to do from August. So this is the other thing we see in OPEC, non-OPEC. They're going to take more frequent decisions and for shorter terms, given the uncertainty in the market. But as things stand now, and we've heard some signals from Russia over the past few days that it seems like Russia at least will be pushing for it to taper to 7.7 million barrels per day starting August.
Right. So with this, when we're talking about, say, $60 per barrel being the new $100 per barrel, but what is the kind of range one should be looking at as the new normal? Because that's going to be the highest point probably that we could even see right now. But if someone has to look at a broad range, what should that be?
So while I totally appreciate the weight pulled by this phrase, the new normal, it explains a lot in just 3 words, but I'm a bit wary of using it as an all-encompassing phrase for the kind of situation that the world is in. So the way I see it, I would call a new normal as a relatively temporary phenomenon. I define that as the period when we are still operating under the shadow of the coronavirus. So there's no, let's assume until, there's no vaccines, no cures. Perhaps it subsides, but then comes back, or at least, keeps popping up in pockets, a bit like whack-a-mole. So that's the sort of new normal situation that I envisage, and with basically, and I think we've already stepped into that new normal. So as we see, countries are dealing with those outbreaks, clusters, with very quick, prompt response, very testing, tracking, tracing the individuals involved and quarantining them. But, and this is very important to my mind, we have already stepped into that era stage, I would call it, where the world is learning to live with the coronavirus. So to my mind, I like to define that as the new normal, when we're learning to live with the coronavirus, not going back to draconian lockdowns, but, taking aside from tracking, testing, and so on, other measures like safe distancing and wearing masks and so on. In this phase of new normal, I really don't see much scope for crude prices to go much higher than where they are now. So my current estimates, projections are that we might see, let's say Brent is around 42, let's call it today, perhaps into the high 40s or 50s by the end of this year, if not in the third quarter. But I don't see, as long as we are living in this under sort of restrictions, some of them are going to be self-imposed, even if governments are not that strict any longer. I believe they won't be, because there's the economy to think of, right? But there will be these restrictions. We'll fly less. We'll probably do more telecommuting. We'll probably do more of these kind of chats than we did in your studio in Bombay last year, right? So there will be less of oil demand. The next step, I call it the big reset button. What happens when we come out of this? And then you have to take a whole lot of other things into account. So it's not just the coronavirus, but the economy of the world has been brought down to its knees. So how do countries get out of this recession? Right now, the stock markets are doing phenomenally well for this kind of a situation, because there's lots of pump priming going on, and lots of stimulus measures. But to what extent are countries able to drive their economic growth with the current measures? I think there'll be a big question mark on that.
Right. So do you think, once the supply cuts have reduced, how long do you think will it take for demand to come back? Because even if the supply cuts are reduced by OPEC plus, and if there is no demand, again, there is going to be a tug of war between the pricing side as well.
So as of now, according to the agreement they made on the 12th of April, OPEC and non-OPEC have actually set a roadmap for production cuts to go all the way out till April 2022. Now, they had put one number for May and June, another number for July to December this year. Then, of course, that's now going to be August to December. So it was 9.7, 7.7, and about 5 million barrels per day of cuts starting next January. However, that's the longer term plan, the cuts from next January, let's say, all the way to April 2022. I think it's basically a placeholder, if you will. So OPEC wanted to give that signal to the markets that it is now very much, the alliance is back on track, and they are determined to control, to rein in production until it is required. But I think what will probably happen, to my mind, going forward is they will modulate these numbers. Of course, as I said earlier, they'll probably, I expect them to meet more frequently, to take stock of the market much more frequently, and they'll modulate it. So depending as on when demand comes back. Now, right now, the sort of consensus view, and again, this will probably continue to change in a big way as we proceed. But right now, the consensus view is that if you talk about the normal global oil demand, let's call it about 100 million barrels per day, that was let's call it the 2019 average, the normal, okay, because it's the pre-COVID normal, if you will. That the world is expected to start or to get very close to that number sometime in the second half of next year, not until then. And I say even close and not add that number, because again, the expectation right now is that jet fuel will probably be the absolute last product, if at all it does get back to a normal, because all the border restrictions are expected, not all, but quite a few are expected to remain in place, visa restrictions. And then let's face it, I mean, people will probably, people like you and me, our viewers, we all are responsible for our own safety as well, right? So we'll probably avoid unnecessary travel. So that's how it's looking. But the one thing I just do want to point out here, however, and I think this is important to understand. I think ideologically, there's been a shift in OPEC, non-OPEC. I do believe that they will not tighten the markets to the extent that, let's say, WTI today, like as you said, overnight it hit $40. It goes up to 50 or remains at or above those levels in a sustained manner, because that's supposed to be the sort of the golden number figure around which a lot of shale growth is expected to come back. So in terms of how OPEC, non-OPEC might manage the cuts, and in terms of my price expectations, I think they will. That's why I don't believe we'll see anywhere above 50 in a sustained manner anytime soon.
Absolutely, and as you mentioned about jet fuel as well, I think everyone's of the opinion that demand on that front will at least take another 1.5, 2 years to get back to normalcy. So that's going to be one of the bigger hits that we are going to look at as well. But where do you see US crude oil production heading from here on, if you have to take a view for the next 1 year?
So US crude production last year in 2019 was around 12.2 million barrels per day. Of course, a historic high. And this year, again, the projections vary a little bit. Now, of course, the bottom line is that everyone has agreed that this year it's going to be a drop in production. It's also quite a consensus around the view that there will be another drop next year. But then beyond that, there's a bit of difference. The main reason for that is that, well, first of all, there's sort of a divided opinions. A lot of us who have been looking at the oil markets for a long time know very well we have seen shale down on its knees and just bounce back up, right? So there's a school of thought that it will rise like the phoenix from ashes once again. And then there's others who think that this time the body blow to shale is just so tremendous that it's not going to come back up. I am in the second camp. I look at very, very closely at what, for instance, how they have been laying off drilling rigs, more than 70% drop just compared with the start of this year. If you look at the fracturing fleets that they use, also more than a 70% drop since the start of this year. But you may say, so what? As soon as prices go up, they will come back in. So there's two points to that. So first of all, as I said, I don't think OPEC, non-OPEC now actually also have much more control over prices, right? Because unless demand comes back to normal, which is a long way off, how they modulate the supply will essentially dictate prices. And the second thing is that I think shale this time around has really lost the confidence of the capital markets in a very big way. It's a very, very debilitating blow. We had a study out overnight from Deloitte that they will have to write off nearly $300 billion of assets starting from the second quarter of this year through the end of this year. We're already seeing bankruptcies. We've seen quite formerly strong independent shale producers warn of bankruptcy. So shale is not coming back anytime soon. I expect shale. Shale is about 70% of U.S. crude production. So pretty much what we say for shale is true for U.S. production as a whole. It's been the main driver of U.S. production growth. I expect U.S. production to go down by at least 1 to 1.2 million barrels per day this year compared with 2019.
Right. So with this is an interesting point that you made with regards to shale gas as well. But if you have to look at a downside from here on in terms of crude, Vandana, do you think there is a possibility that we could again go down to those $20 per barrel, $15 per barrel? And if yes, what are those downside risks that we need to watch out for?
That's a very good question. In fact, yesterday I got asked a question, sort of a modification of this is that so if we are sitting at 40 today, where do we go next? Do we go to 20 or do we go to 60, right? And to that question, I replied that neither. I think we are going to be pretty range bound around 40 right now. But to your question, the memory of April, Brent at 19 and WTI at negative $37, $40, that's left a deep scar. And I don't mean to be facetious or joke about this because I do know that a lot of retail investors, unfortunately, have also lost huge sums of money when that happens. So it's just something that it's going to be very hard to forget and very hard to erase. But I do feel that we have moved on. So as far as this pandemic is concerned, I think we have moved on from that very, very extreme state that the world was in, where we had 25% of the demand that had disappeared. And don't forget, at the same time, OPEC, non-OPEC were in a price war. So they were actually pumping, up to 2 million barrels per day extra. So, everything that could go wrong in terms of go south for oil had gone south. I think that's not going to happen. I say that a little bit tentatively. So my base case is that we are not going to see such a big second wave of the coronavirus that that it triggers widespread lockdowns, because that's probably to my mind, that's the sort of situation that could pull prices back down to those levels. But that's not my base case. It is a tail risk, yes. I think it'll remain until we find a way to get rid of this pandemic altogether, but not my base case. So I don't expect prices to plunge certainly not to those levels again.
Right. So clearly, I mean, the odds of a V-shaped recovery with regards to where oil demand is concerned, that's something which is shrinking. So with this, where do you think, or how long do you think will it take the demand to come back to pre-pandemic levels?
So what we have started seeing since May, we saw the worst hit European economies starting to reopen, and of course, not to forget China, which was the first up the curve and down the curve, and China had started opening back in April, and that was the first rebound of demand that we saw, and that's not a unimportant one. China is the second biggest consumer of oil, but that did not give much impetus to prices in April because the rest of the world was in the worst phase of the lockdowns back in April. So what we've started seeing from May as economies have been reopening is that gasoline or petrol demand has been the first one to rebound. Pretty much that's the case around the world. So that is directly connected to people being out and about and driving in their cars, personal vehicles. And in some of the cities around the world, it's also been propelled, the recovery has been propelled by people people preferring to drive rather than use public transport where and when they do have the option. So gasoline demand has come back. The second phase appears to be gas oil. Just behind gasoline, we're seeing gas oil or diesel demand. So diesel demand is most directly tied with the revival of industrial production, in countries where like China, where, factories, manufacturing and so on took a little while longer to come back because there's also all those disrupted supply chains. And also, even if people were driving and being back into their workplaces or factories, that didn't mean that the factories were back to 100%. So we're seeing diesel sort of follow very closely behind gasoline. And as I mentioned earlier, jet fuel is the biggest laggard, and it's probably not going to come back anywhere close to normal, perhaps even until 2022. So basically, that's the sort of sequence that the major oil products are following.
Right. And with this, do you think we are already in that phase where, say, Brent futures have already got into backwardation right now?
So indeed, it has been in backwardation starting last Friday. And again, just for the benefit of our viewers, backwardation is where the prompt prices are higher than prices of the crude or the product for the subsequent months. And typically what that means, a curve like that, price curve like that means is that markets are either quite balanced or even tight. So that's a phenomenon, especially where is the first month and the second month Brent trading. That's quite a closely watched number or spread. The same goes for Dubai, another benchmark crude, for WTI, Oman, and so on. Actually, interestingly, the sour crudes, Dubai and Oman, have been in backwardation in the front 2 months for, I think, probably at least 2 weeks now, and that is because when OPEC cuts, it's usually the sour crude that whose supply is reduced first. Brent did flip into backwardation, but it's a very small one. It was like, I think 4 cents, 5 cents. Overnight, it was just about 1 cent. What that tells me is that there's still a bit of tentativeness about it. For the market, it will need the market to be like absolutely convinced that now that the tightened supply that we saw more in the sour crude is now indeed becoming a global phenomenon, that even it's translating into sweet crude as well, or low sulfur crude, which is what the Brent benchmark is. So, but again, nonetheless, it's a good point you brought up, because that will be something that the market keeps a very close eye on. As we see, if we see that backwardation starting to steepen, or that spread starting to rise, I think that'll be more convincing for the market. Another sign that indeed we are moving into perhaps an even undersupply situation now from an oversupply one.
Right. In fact, one of the viewers has set a question on the same as well, as to how do you see light, heavy, sour, sweet crude spreads moving over the next 1 to 2 years, as there has been, that's something which has been capping the refining margins for complex refineries as well.
Absolutely. And I think that is a spread that is very closely watched, especially in Asia, because certainly true for India, but even the rest of Asia, the refiners are geared more towards processing sour crude. So again, so we're talking here about the difference between the prices of, let's say, a benchmark sour crude like Dubai and a benchmark sweet crude like Brent. So Brent Dubai spread, as it is called, is what the refiners track very closely. Now, typically and historically, sour crude, or the high sulfur crude, obviously sulfur being an unwanted product or byproduct in the processing and burning of fuels, sour crude trades at a discount to sweet crude. Now, what we've seen in the past, I think it's been more than a couple of weeks that we saw Dubai actually trading at a premium to Brent. And this was that phenomenon, I think, probably started in April, but certainly through May, is because OPEC was just tight. It's not that there was more demand for sour crude. To some extent there was, because Chinese demand was coming back, but it was more because OPEC had tightened in an unprecedented quantum of supply, and that essentially tightened, or that essentially pulled up Dubai prices. Now, going forward, as long as we see OPEC continuing its very tight cuts, very high cuts, which even if they taper relative to history of OPEC cuts, even at 7.7 million barrels per day, these are going to be quite a significant amount of cuts. So I do think that proportionally there will be more of sour crude being removed from the market. And as long as this supply tightening is determining the balance of the markets, is determining overall crude prices, which is the case when the pandemic is affecting the world, I do feel that spread will remain very, very tight. So it's hard to say beyond that. We've seen it go into negative. I don't expect it to remain in the negative for very long. And also keeping in mind that the shut-ins and the declining production in the US will also tighten sweet crude supply. So I think, to my mind, it's just a matter of time until the sweet crude supply tightness also sort of starts to catch up with the sour crude tightness. But I would expect that spread to remain very, very small. So basically, then what I'm saying is that even in positive, the sweet crude or Brent will have a very narrow premium to sour crude.
Right. So what are your thoughts with this, Vanda, with regards to where rationalization of capacities is concerned in upstream oil production, as well as if you have to look at downstream refining industry?
So, without doubt, there has to be rationalization. The world, the world in general, until this happened, there was a very steady uptick in global oil demand, year on year. That growth was starting to taper as well. And, we were talking about perhaps getting in the next decade to a plateau of oil demand. Now, when we say growth was, there was a small growth happening every year. Obviously, that growth was in refined products. So what that sort of growth needs, of course, is more crude oil production, which wasn't much of a problem, but it also needs enough refining capacity. The problem now that started to happen is that we're also at the same time, not just because of nothing to do with the pandemic, but the world has been moving towards cleaner and cleaner fuels. So what that needs, what the need of the world right now is high complexity refineries, which can take the trashiest, high sulfur, high acid, heavy crudes and turn them into the cleanest fuels. So when we think of rationalization in the refining sector, I think there's a couple of factors that will determine where this rationalization happens. One will be refineries where the demand, local demand, captive demand that refiners have. So, one is you sell to the domestic market, and one is, of course, you export if you have a surplus, or you could just be an export oriented refinery and export, right? So when I look at country like India, for instance, or like even China, there's a very strong base of captive demand and a growing base as well. So to my mind, these refineries, that helps put a sort of a floor under the refineries in such countries. But another example is take Philippines. The only two refineries, relatively old, relatively mid-sized, have closed down. Now they haven't mothballed, but they said we're closing down, and we don't know when we will be able to reopen. There's plenty of products out there, and we just can't make our margins when demand has slumped like that. So we may see, and then Japan is another place where even much before this pandemic, they've just been reducing their refinery capacity because Japan is that one country in Asia which really stands out because its oil demand has been consistently declining for more than a decade now. So that's the sort of discriminatory factor, if you will. What will help refiners survive, and what will perhaps force them to shut down or rationalize. The other one is going to be obviously the age and complexity of the refinery. Now, if you cast an eye across the world, a lot of the refineries in Asia have actually, aside from Japan and Australia and the Philippines, a lot of them have actually, quite a lot of them are new. Quite a lot of them also have economies of scale. The newer refineries tend to be bigger as well, 400, 800,000 barrel per day CDUs. So in Asia, that will stand them in good stead. But if you look at Europe, that's where it's the sick man of the refining sector. It's an unfortunate analogy, but that's what it is. These are old refineries, relatively smaller refineries. They've not been upgraded. So, in a nutshell, I think that's where I will expect refining capacity to close, aside from pockets of, like perhaps the Philippine refineries may not come back. Japan will definitely shut down some more capacity.
Right. And very lastly, Vanda, with regards to where the benchmark goes, all of us have been either looking at Brent or WTI as a benchmark. Do you think that's the right benchmark to follow, or do you think that the world really needs a new benchmark with regards to crude?
We'll need another half an hour to discuss this. But it's tough. When it comes to benchmarks, they are not established overnight. We all know that. And there's a host of factors that prop up a particular crude or a refined product in a particular location with particular specifications to become a benchmark. So some of the qualities, of course, is that there has to be enough production. If there's not enough liquidity, enough not buying and selling going on, then you say, I don't have confidence in today's number. Nothing transacted today. What is today's number? So enough liquidity, a wide pool of players, enough buyers, sellers, and so on. And then transparent, not controlled by any or too much by a particular party or parties, and so on. So so when you look at Brent, TI, arguably, some people will say it perhaps reflects the US dynamics much more than global dynamics. I would tend to agree. I think by and large, Brent and Dubai are seen as the two major benchmarks. The oldest discussion in the markets has been that should Asia have its own benchmark? And there's been a lot of countries in the region, and here in Singapore as well, where exchanges have tried to create a benchmark. And, unfortunately, they've realized that, it's not as easy as that. We had the Shanghai International Exchange set up a crude futures. It's nowhere near becoming a benchmark. Even China has not managed to use it for its own crude purchases. So I think to my mind, Brent and Dubai are serving the purpose right now. The companies that are behind these, so Brent is of course is Platts, as well as the ICE futures is used as benchmark. Dubai is a Platts benchmark. So again, having been in Platts and seen how they make sure that these benchmarks are kept robust, I do have full confidence that the companies will make sure, that that remains the case for as long as they can.
Absolutely. I mean, we'll have to look out for something, and I think it'll take long for to get new benchmarks as well. But thank you, Vanda. Thank you so much for joining us on the show. It was a pleasure having you. Great insights, and just hoping that we again see that light of probably $60 per barrel sooner than later right now, so that things are improving. But hope you stay safe from here on as well, and hope to see you again once you're in Bombay.
Thank you very much.
Thank you, Vanda.
Thanks.